The most expensive pullback is not the one you buy too early. It is the one you understand correctly, watch carefully, prepare for patiently, and still fail to buy because the market finally gives it to you with fear attached. That is the quiet punishment of hesitation. The chart comes back into an area you marked in advance. Price slows where it should slow. Weak hands begin to sell. Late buyers begin to doubt. And the very condition you were waiting for now feels like a warning. You wanted a better price, but when the better price arrives, it feels dangerous. That is not an accident. That is the market testing whether your plan was real, or only comfortable in theory. A pullback does not arrive wearing the appearance of safety. If it did, there would be no opportunity in it. It comes with red candles, lower ticks, nervous volume, sharp opinions, and the small inner voice that says, maybe this time something is different. The trader who cannot distinguish normal reaction from true reversal will treat every discount as a threat. He will demand certainty before acting, and by the time certainty appears, the advantage has usually passed into someone else's hands. This is where a trader begins to learn that price is not enough. You must also read behavior. Who is trapped? Who is taking profits? Who is selling because the trend has changed? And who is selling merely because they cannot hold through discomfort? These are not abstract questions. They decide whether you buy into strength returning or whether you step in front of genuine weakness. There is a difference between a market pulling back to gather energy and a market falling because sponsorship has disappeared. One respects prior structure. The other begins to destroy it. One shakes loose impatient traders and then steadies itself. The other accepts lower prices without resistance. Your task is not to be brave in every decline. Your task is to observe whether the decline is controlled, whether selling pressure is being absorbed, and whether the market is returning to a place where risk can be defined. Fear loses much of its authority when risk is specific. Hesitation grows in vague conditions. If you do not know where your idea is wrong, every tick against you feels like evidence. If you do not know what kind of pullback you are waiting for, every dip looks either tempting or terrifying. A trader who has not defined his conditions before the move begins will be forced to make decisions while emotion is loudest. So when price pulls back, do not begin by asking, is this safe? That question will mislead you. Nothing in speculation is safe. Ask instead, is this behavior consistent with a market that is still under accumulation, or am I seeing distribution disguised as opportunity? Notice how price reacts at prior demand. Notice whether volume expands recklessly or dries up as the decline matures. Notice whether failed sellers are forced to cover. Notice whether the market begins to refuse lower prices. These details do not remove risk. They give risk a shape. And once risk has a shape, hesitation can be studied rather than obeyed. The deeper lesson is that buying pullbacks is not an act of courage. It is an act of preparation meeting discomfort at the proper moment. And before that moment can be mastered, you must understand the first distinction that separates a professional entry from an emotional guess. The fear you feel before buying a pullback is rarely caused by the pullback itself. It comes from standing in front of uncertainty without knowing what the trade is allowed to cost you. Price may be doing exactly what you expected, but if the consequence is unclear, the mind treats the moment as danger. You are not only looking at a chart, you are looking at a possible mistake, a possible loss, and a possible judgment against your own ability. This is why a trader can plan a pullback calmly while the market is rising, then hesitate when price returns to the level he wanted. Nothing has changed except the emotional setting. When the market was far away, the idea had no immediate consequence. It was clean, intelligent, and easy to believe. But when price reaches the area, the decision becomes real. Now the trade can fail. Now the account can move. Now the trader must accept responsibility. Fear grows strongest where the boundary is missing. If you do not know exactly what proves the idea wrong, every tick against you feels meaningful. A small dip feels like a warning. A wider candle feels like confirmation that you should wait. A brief pause feels suspicious. The market has not necessarily changed its character. Your mind has begun searching for protection. Because you never gave it a clear line of invalidation. This is a quiet but serious problem. Without a defined consequence, the trader demands emotional certainty before acting. But the market does not pay for certainty. It pays for taking measured risk when conditions are still imperfect. If you wait until fear disappears, you will often be waiting until the opportunity has already moved away. Then you are left with a worse choice: chase higher or watch the trade work without you. There is discipline in saying, this is where the idea is wrong. Not because the line is perfect, but because it separates analysis from fear. A trader who has defined the failure point can observe the pullback with a steadier mind. He does not need every candle to comfort him. He does not need the market to prove safety, because he already knows the price of being wrong. That knowledge reduces the size of the unknown. You must understand this clearly. Fear does not disappear because you become bold. Fear weakens when the trade becomes specific. The entry area is specific. The invalidation is specific. The reason for the trade is specific. The amount of room the market should reasonably have is specific. When these pieces are missing, the mind fills the empty space with imagination. And imagination, under pressure, usually leans toward danger. Ask yourself this before the pullback arrives: what would tell me that this is no longer a pullback, but a failed idea? Not what would make me uncomfortable. Not what would make the candle look ugly. Not what would cause other traders to panic. What would actually prove that the reason for the trade is gone? That distinction matters. Discomfort is not invalidation. Noise is not invalidation. A normal test of the area is not invalidation. Once you can separate discomfort from disproof, you begin to see the market more cleanly. A pullback may still feel unpleasant, but unpleasant is not the same as dangerous. The trader who confuses the two will step aside from his own best trades. He will call it caution, but often it is only undefined risk wearing a respectable name. So before you try to master buying pullbacks, master the consequence of being wrong. Decide what failure looks like while your mind is still calm. Decide what price behavior cancels the idea before the market presses you for an answer. Then, when the pullback comes, you are not negotiating with fear in real time. You are comparing present behavior against a boundary already chosen. Only after that boundary exists can the next problem be faced: how to prepare the actual entry before the market reaches it, so the moment of action does not become another moment of hesitation. A pullback entry is usually lost before the price ever reaches the level. It is lost in the minutes, hours, or days when the trader sees the setup forming, but does not decide how he will act. He tells himself he is waiting for the market. In truth, the market may be waiting for him to become precise. When price begins to return toward an area of interest, the unprepared trader watches too much and decides too little. He sees the candles move lower. He notices the hesitation. He feels the pace of the tape change. But because he has not chosen his entry conditions in advance, every new tick becomes another reason to reconsider. The opportunity is no longer a setup. It becomes a debate. Execution does not begin when you press the button. It begins when you decide what must happen before the button is worth pressing. Will you buy at the level itself? Will you wait for price to touch the area and reject it? Will you require a close back above a short-term level? Will you enter in pieces as the market tests the zone? These are execution questions, not afterthoughts. If they are answered late, they will be answered under pressure. A trader who waits for the pullback without a trigger is not being patient. He is being vague. Patience has conditions. Vague waiting has none. This difference matters because the market often gives opportunity in imperfect form. It may touch the area quickly and bounce. It may spend time there and shake both sides. It may dip slightly below the obvious level before recovering. If you have no prepared method, you will either freeze because the move is too fast or chase because the move is already gone. There is also danger in asking the market for too much confirmation. A pullback offers value because it comes before complete agreement returns. If you demand that every sign turn favorable before entry, you may receive comfort, but you will often lose position. The later you enter, the more you usually pay for certainty. That higher price may feel easier, but it can leave less room for reward and more room for regret. Your task is not to find the perfect entry. Your task is to define a professional entry. A professional entry is one that can be planned, repeated, and judged later. It has a location, a trigger, an order type, and a reason for acting. It does not rely on a sudden feeling that, now is the moment. Feelings cannot be reviewed with discipline. Conditions can. Before the pullback arrives, mark the area where action may be justified. Then decide what behavior will activate your entry. Perhaps price must test the zone and fail to continue lower. Perhaps buyers must step in after sellers press. Perhaps a smaller time frame must stop making lower lows. The exact method may vary, but the principle does not. You must know what you are waiting to see before the market shows it. Then decide how you will enter. A limit order gives you price, but may fill you before the market proves any response. A stop entry after strength returns may give confirmation, but at a worse price. A scaled entry may reduce the need for perfect timing, but requires discipline in size and placement. None of these methods is always superior. Each has a cost. The mature trader chooses the cost knowingly. This is where many traders fail quietly. They think their problem is courage, but their real problem is an unfinished instruction. Buy the pullback is not a plan, it is only an intention. A plan says where, when, how, and under what condition the order is no longer valid. Without that detail, the trader is forced to invent his process while the market is moving. So prepare the entry while your judgment is still undisturbed. Write the condition. Mark the level. Choose the order behavior. Know whether you are waiting for touch, rejection, recovery, or continuation. When price finally comes back, your work is not to create a decision from nothing. Your work is to recognize whether the decision you already prepared has arrived. But even the cleanest entry process must answer one harder question. Does the trade still deserve your capital when the numbers are placed against the risk? A pullback can look attractive and still be a poor trade. The lower price may please the eye, but the market does not reward a trader for buying something merely because it has come down. It rewards him when the distance between what he risks and what he can reasonably gain is favorable enough to justify the attempt. This is where many traders misread the advantage. They see price returning from a recent high and assume the trade has become cheaper. But cheaper is not the same as better. If the proper stop must be placed far away, the trade may require too much risk. If the likely reward has already been reduced by nearby resistance or limited upside, the trade may offer too little return. A better entry price only matters when it improves the equation. Every pullback has a mathematical shape. There is the entry price. There is the point where the idea is wrong. There is the area where profit could reasonably appear. These 3 points form the trade before any emotion, opinion, or prediction is involved. If the loss side is large and the reward side is small, the setup is not rescued by confidence. It is damaged by arithmetic. A trader who ignores this begins to take trades that feel intelligent but behave poorly over time. He may win some of them. He may even feel skilled because he bought weakness before a bounce. But if each loss is too large compared with each gain, a few normal failures can erase several correct decisions. The damage does not come from being wrong once. It comes from repeatedly accepting poor terms. This is why risk to reward is not a decorative number. It is the price of participation. Before you buy a pullback, ask what the market must give you if you are right, and what it will take from you if you are wrong. If you risk 1 unit to make 1 unit, you need to be right often. If you risk 1 unit to make 3, you can survive more ordinary failure. The trade does not need to be perfect when the terms are sound, but when the terms are weak, even good analysis must work too hard. Position size belongs to the same calculation. A wide stop does not automatically make a trade bad, but it changes the size you can responsibly carry. If the distance to the failure point is greater, the position must usually be smaller. If the stop is tighter, the position may be larger, but only if that tighter stop still gives the trade proper room. Size must answer risk. It must not answer desire. Do not judge a pullback by how much price has fallen. Judge it by whether the fall has created a clean relationship between entry, invalidation, and potential reward. A shallow pullback may offer strength but poor reward. A deeper pullback may offer better reward, but require more proof that the trade has not been damaged. The numbers do not tell you everything, but they prevent you from paying too much for an idea. You should also avoid forcing a trade just because the setup looks familiar. Familiarity is not expectancy. A trade becomes worth taking only when it fits within a repeated model that has shown an advantage over many attempts. If your average winner cannot pay for your average loser, hesitation is not the enemy. The trade itself may be the problem. So before the entry is taken, reduce the pullback to its terms. Where is the entry? Where is the loss accepted? Where is the first reasonable area of reward? How much capital is at risk if the trade fails normally? If these answers do not produce a favorable equation, there is nothing noble about acting. Passing is not fear when the numbers are poor. The purpose of mathematics is not to make the trade certain. It is to keep one trade from becoming too important. It forces the trader to respect proportion. It reminds him that survival does not come from being right on every pullback, but from taking only those pullbacks where the reward justifies the risk. And once the numbers allow the trade, the next question becomes more demanding. Is the market's behavior still strong enough to deserve the calculation? A market does not become buyable simply because it has pulled back. Price can decline in a healthy way, or it can decline because the character of the move has changed. To the careless eye, both may look similar for a short time. To the trained eye, they leave different evidence. A healthy pullback usually respects the structure that built the advance. It may retrace, test, hesitate, or shake out late buyers, but it does not immediately destroy the foundation beneath the move. Prior demand areas still matter. Former resistance may begin to act as support. The decline may slow as it approaches an important zone. Sellers may push, but they struggle to keep control. This is not prediction. It is observation. A damaged market behaves differently. It does not merely return to structure, it cuts through it with acceptance. Levels that should attract buyers fail to hold. Bounces become weak and brief. Selling expands instead of tiring. Each attempt to recover is met with supply, and price begins to spend time where it should not spend time if buyers are still in command. When this happens, the pullback is no longer resting. It is warning. You must learn to read the difference between a market that is shaking out traders and a market that is losing sponsorship. A shakeout often creates temporary fear but fails to follow through. Price may pierce an obvious level, draw in sellers, and then refuse to continue lower. That refusal matters. It tells you the selling may be less powerful than it appears. But when price breaks, retests, and continues lower with acceptance, the story is different. The market is not trapping sellers, it may be confirming them. Volume and speed can help, but they must be interpreted with care. Heavy selling into a pullback is not always bearish if price refuses to fall much further. That can mean supply is being absorbed. Light selling is not always bullish if price keeps drifting lower without resistance from buyers. That can mean demand is absent. The question is never volume alone. The question is, what result did that effort produce? This is one of the quiet arts of pullback trading. You are not only watching price move down, you are watching how the market behaves when it reaches a place where buyers should care. If buyers are still present, the decline often begins to lose authority. Candles narrow, downside progress slows. Failed breakdowns appear. Sellers who entered late receive no reward. The market begins to show that lower prices are being rejected, not welcomed. But if the market accepts lower prices easily, do not argue with it. A trader who insists on buying because the prior trend was strong may be looking at an old fact. The market is always testing whether yesterday's strength still matters today. When former demand becomes empty, when rallies cannot regain lost ground, when price stays below areas it should have reclaimed, the pullback may be revealing distribution rather than opportunity. This does not mean every broken level must be feared. Markets are not clean machines. They probe, overshoot, and mislead. But disorder is different from weakness. A disorderly pullback may still defend the larger structure. A weak pullback begins to erase the reason for buying it. Your work is to judge behavior in context, not react to one candle in isolation. So when the pullback arrives, Study the market's response at the important places. Does price slow where demand should appear? Does selling pressure create less progress than expected? Do sellers fail after pressing the low? Do buyers step in with enough force to change the short-term tone? Or does the market accept lower ground without protest? These observations keep you from buying every decline blindly. They also keep you from fearing every decline automatically. A pullback worth buying should show that the larger move is still alive beneath the temporary weakness. It should reveal that sellers are present, but not in control. It should show pressure being tested, absorbed, and gradually answered. Once that behavior is visible, the trader faces a more personal test. The market may have given structure, behavior, and evidence, but the decision still must be made under imperfect conditions. The difficult moment in buying a pullback is not always the analysis. Often, the chart has already given enough information. The level is known. The reaction is visible. The risk has been measured. The market has behaved well enough to deserve attention, yet the trader still pauses, because the final decision does not feel clean. This is where comfort becomes a dangerous advisor. Comfort usually arrives after the easy part of the move has already passed. It appears when price has lifted from the pullback, when other traders have stopped doubting, and when the chart looks obvious again. But by then, the entry may no longer offer the same advantage. The trader who waits to feel comfortable often pays for that comfort with worse position, reduced reward, and greater frustration. A trading decision must not be built on the mood of the moment. Mood changes with each candle. One strong push lower can make a sound setup look threatening. One sharp bounce can make a poor decision feel urgent. If your decision process rises and falls with the last few ticks, the market will move your judgment before it moves your account. You will not be reading price. You will be reacting to pressure. Conditions exist to protect the trader from this weakness. A condition is a simple standard that must be present before action is allowed. It may concern the area, the behavior, the trigger, the risk, or the reward. The exact standards belong to the trader's method, but the principle is always the same. The decision must answer to evidence, not comfort. This does not mean you become mechanical in the foolish sense. Markets require judgment, but judgment is not the same as improvisation. Judgment weighs what is present against what was required. Improvisation changes the requirements because the moment feels uncomfortable. The first is discipline. The second is emotion pretending to think. When a pullback reaches the area, ask yourself plainly, are the necessary conditions present, absent, or unclear? If they are present, hesitation has no special authority. The trade may still fail, but failure is part of the business. If the conditions are absent, action is not discipline, it is impatience. If the conditions are unclear, waiting is not weakness, it is respect for uncertainty. This simple separation prevents many costly errors. It stops you from buying merely because you fear missing the move. It stops you from avoiding a valid entry merely because the candle looks unpleasant. It stops you from changing your standard after the market has already forced emotion into the room. Cause and effect become visible when conditions lead. Decisions become cleaner when comfort leads. Decisions become late, inconsistent, and difficult to review. You must also accept that a proper decision will often feel incomplete. The market rarely gives all the evidence at once. It gives enough, or it does not. The trader who demands full reassurance has misunderstood the work. You are not trying to remove uncertainty. You are trying to act only when the uncertainty is organized enough to be carried. This is why a decision checklist can be useful, not as a crutch, but as a guardrail. Is price at the planned area? Has the market behaved in a way that supports the idea? Is the entry condition present? Is the failure point still valid? Is the reward still worth the risk? If the answer is yes, then the decision has already been made by your standards. If the answer is no, there is nothing to negotiate. Do not let the market turn every pullback into a private argument. The more you argue in real time, the more likely you are to choose the action that relieves discomfort rather than the action that respects your method. Relief is not the same as good judgment. Sometimes relief comes from entering too soon. Sometimes it comes from avoiding a trade you should have taken. In both cases, the trader serves emotion and calls it discretion. A calm decision is not always a calm feeling. It is a decision made from conditions that remain steady while feeling changes. That is the difference. You may still feel pressure, doubt, or reluctance. But if your conditions are sound and present, those feelings become background noise rather than command. And for this kind of decision, making to become reliable, it cannot be invented only when price is moving. It must be supported by the quiet work done before the session ever begins. A trader does not become calm at the moment of the pullback. He brings calm with him, or he discovers that he never prepared it. The market has a way of exposing unfinished work. When price begins to return toward a possible entry area, the trader who has not rehearsed the situation must think, judge, decide, and control himself all at once. That is too much weight for one moment to carry. Professional habits exist, because the market rarely gives time to become professional after the opportunity appears. The work must be done while nothing urgent is happening. Before the session opens, before the level is tested, before the candle begins to move quickly, the serious trader has already studied where opportunity may form and what kind of behavior would matter there. He is not surprised by the pullback because he has already met it in his preparation. This preparation is not complicated, but it must be honest. Mark the areas where price could logically return. Write the possible scenarios. One scenario may show price testing the level and holding. Another may show price cutting through it and making the idea unfit. Another may show price approaching the level but never giving enough response. When these paths are considered in advance, the live market feels less like an attack and more like the unfolding of something already studied. The habit of rehearsal changes what you notice. An unprepared trader sees movement first and meaning later. A prepared trader sees whether the movement matches one of his planned scenarios. That difference is important. If you only react to motion, the market can lead you anywhere. But if you have rehearsed the setting, you can watch with discrimination. You are not asking, "What do I feel about this candle?" You are asking, "Which prepared possibility is taking shape?" Screenshots are one of the plainest tools a trader can use. Study prior pullbacks that worked and prior pullbacks that failed. Do not look at them casually. Note where the decline began, how price approached the area, how long it stayed there, how sellers behaved, and what the first signs of recovery looked like. Over time, repeated review trains the eye to recognize familiar conditions without pretending that any two trades are identical. Written notes serve another purpose. They prevent the trader from rewriting his plan after the fact. A plan kept only in memory is too easy to bend. When the market moves, memory becomes generous. It will say you planned something you never planned. It will excuse an entry that had no preparation. A written scenario holds the trader accountable to the work he claimed to respect. There is also value in rehearsing what you will not do. The professional does not only prepare for action, he prepares for restraint. He knows which pullbacks are not his business. He knows where he is likely to be tempted. He knows what kind of sudden move usually draws him into careless participation. By naming these dangers before they appear, he weakens their power when they arrive. This is why preparation must be repeated, not performed once as a display of discipline. One good morning routine does not build a professional mind. The market changes tone, speed, range, and pressure. The trader must return each day to the same basic work review: mark, write, rehearse, and wait. The repetition may seem ordinary, but ordinary work done faithfully is what makes action appear steady when others are unsettled. Do not confuse this with trying to predict every move. The purpose of rehearsal is not to control the market. It is to reduce the number of decisions that must be invented under pressure. A trader cannot know what price will do, but he can know what he will pay attention to. He can know which areas matter. He can know which scenarios are acceptable and which are not. That knowledge gives the session structure. Before you trade the pullback, rehearse the pullback. See it before it comes. Write the conditions before they are tested. Review the examples before the market demands recognition. Prepare not only for the trade you hope to take, but for the trade you must refuse. Then, When price finally reaches the place of interest, you are not meeting the situation for the first time. But preparation only brings you to the entry. Once the position is open, the market begins a different examination, whether you can manage the trade without letting the old disorder return. The first test of a pullback trade is getting in. The second test begins the moment you are filled. Many traders prepare themselves for the entry, but not for the behavior that follows it. They think the hard part is over once they buy. Then the market moves a little against them, pauses too long, or gives back an early gain, and suddenly the same disorder returns in a different form. A pullback entry rarely moves cleanly from your price to your target. It may test the entry again. It may dip, recover, hesitate, and then move. It may offer a quick profit and then threaten to take it away. This is normal market behavior, but it feels personal when money is now committed. Before entry, the trader observes movement. After entry, he interprets movement as consequence. This is why trade management must be planned as carefully as the entry itself. If you do not know how the trade is allowed to breathe, every fluctuation becomes a decision.